Hey everyone, this is John Feneck with the Feneck Commodities Report. With me for our monthly Zoom is Don Durrett, founder of goldstockdata.com. How's it going, Don?
Hey, John, it's time to do another one.
That's right. So a lot going on in the world, and we have a little over 20 minutes to get through a lot of stuff. So why don't we skip the normal stuff that we do with, Fed and we heard from Powell obviously on June 12th, and it was a nothing burger meeting, other than to say that they are going to cut rates once this year, which I think was interesting that they put themselves into that corner because gold has ascended without any type of black swan event. And I think that by saying this out loud is a real risk for them because they're really betting on a soft landing now, don't you think?
Yes, absolutely. But I also think that their biggest fear isn't really inflation. I think their biggest fear, because I think they kind of feel that inflation's somewhat under control. So I don't think that's their biggest fear now. I think their number one fear is a recession. And the
Yeah.
US is highly leveraged and they don't want that recession to get out of control. And so I think I think over the last 6 months, I think they've pivoted their concerns away from inflation and towards the soft landing, making sure that the soft landing happens, that we don't get kind of a runaway recession. And I think that is on their, that as time progresses into this year, I think that is increasing. And that's why I think the cut is like, I don't think the reason why the cut right now is because of inflation going down. I really don't. I think the cut is because we got to make the soft landing happen. And I don't
Gotcha.
think it's going to. Now, it's Wall Street, this disconnect between what's happening on Wall Street and what's happening on Main Street just keeps getting wider and wider. I mean, we got up to almost 5,500 this week. I mean, the stock market was absolutely nuts. I mean, we closed the day almost 54.25, and it traded above, I think, above 54.50 this week. Just absolutely bonkers because the 10-year, remember, everybody's focused on the 10-year. 10-year came down from 4.5 to 4.2, and they're focusing on that 10-year rate because the 10-year rate is that one in the lower rates, but the 10-year rate is the one that goes up and down because the Fed really doesn't have control of it. So when it comes down, they get really happy. Then you had that inflation number. It was below expectations. So everybody's focusing on the wrong thing. They're focusing on employment, which I think is totally bogus numbers. Like last week they said we had plus 260 and the household survey said minus 400. It's like a huge, huge disconnect. They're like, oh, that household number doesn't mean anything. Ignore that. Don't talk about that. And they
Right.
don't talk about it. They only focus on the BLS number, which is actually BLBS number. And so everybody's focusing on these wrong numbers. And I think that what's really happening here is the economy's weakening, and everybody is really just praying that Fed can land this plane, and it's like it's going to crash. So I think for me, I just think this is a blow off top here, and when it turns, once it starts to turn, I talked before we started this. I was giving you an analogy about a race. People were watching a car race, and one guy was in the lead, and he was just going too fast, and everybody knew it. It's like there's no way this guy can maintain this pace. He's going off the track. It's just a matter of when. And I think the average consumer, the average investor, knows that the car's going too fast, and it's going to go off the track. And once it starts, we just know that we can see it coming. Basically, we're at that stage right now where we can see it coming. And once it goes off the track, it's like that's when the stock market will roll over. And I'll come back. I'll let you talk now. I'm going to come back about this whole risk on, risk off, and how it's impacting gold and silver.
Okay. Yeah. So great comments there. I would add that I would encourage our listeners to look at their retirement accounts since March of '09 to today. Whether you're in the S&P, the NASDAQ, the Russell, you made a lot of money. And I say this almost every podcast because I want to stress over and over again to tens of thousands of people that you should be thankful for where you are in your investment account. A lot of this return since COVID is BS, in my opinion. A lot of these prices are extremely stretched. and they are components of what you own in the S&P, whether you know it or not, right? Like the S&P is so tech heavy that no one would argue that tech has led here, right? So are you at 70 years old or 65 years old willing to take on that risk? Do you even know that you're taking on this risk? Go look at SPY and do the work. You know, it's right there on ETFs.com, or whatever S&P fund you own. Just go look at the holdings and ask yourself, are you cool with that kind of risk? I don't think the average person would answer yes. And I'll tell you, Don, many clients and smart people I've met over the years that are executives at companies, not in finance, right? They don't know how to look at their own statements and assess the risk, right? And because they might meet with their planner once per year, that's not enough, by the way. You need to be talking to people quarterly, especially at this point in the cycle, in my opinion.
Yeah, I couldn't agree with you more. I actually thought about that today. It actually popped into my head because the market is so frothy that people are overexposed, and once it turns, they're not going to know what to do. Do I hold, hold, hold? And I've been saying that once below the S&P, once it's below 5,000, that's when people will start to get nervous. As long as it holds 5,000, Wall Street will say very, very bullish. It's just a little short correction. Don't worry about it.
Right.
Well, we just had the short correction, the 5% correction. We just had it, and it held. The next one probably won't. And so you go below 5, and then below 4,800. I think that's when that's when everybody's going to start jumping off the ship. But I want to go back to this risk on trade that we have right now and how it's impacting gold and silver.
Okay.
So I've been saying on Twitter, I tweet quite a bit, and one of the things I've been saying is that Newmont is kind of a bellwether for the gold miners. You just watch Newmont, and you'll kind of know what the miners are doing. And today was a perfect example. So Newmont, its volume today was absolutely pathetic. It was 4.5 million shares. When Newmont, an average day for Newmont's about 8 million, it's like trading about half. And somebody tweeted to me and saying that all the silver miners are trading about half their volume. On a good day, Newmont should trade at 20 million. It traded 98 million shares on one day in November. So 4.5 versus 100 million. You can see the huge how low the volume is. It should have traded 20 million shares today.
Sure.
And the other thing is that was unbelievable is how tight the range was. Gold went up $20 today, and Newmont could only go up 50 cents, and it ended up 25 cents. It's traded, so it opened about 40.50. And it went up to 41, which is about a 50%, 50 cents, which is nothing. There's like a little tiny little blip up, and then it couldn't hold it. And it ended the day like 40.75, like up 25 cents. I mean, so no volume and nobody wanted to buy it. And that just shows you that Wall Street, because again, Newmont is the big, the largest gold miner. So they're going to have the most liquidity. So if you're a big fund, you're not going to go and try to buy the best stock. You're going to go buy the go-to stock, the kind of best of breed. Now, Newmont isn't best of breed, but it's the big, the largest gold miner. And so it's kind of a go-to name if you're going to buy any gold miner. So you have all the big funds. So a big fund, they can make Newmont move, if you will.
Yep.
So nobody was, and there was a very low volume on it. So basically nobody bought it today on Wall Street. And so that means all the big money is just there. And I've been saying this, all the big money is focused on this risk on trade. Nobody cares about any risk off, which is.
Let's talk about that, because there is a reason, I think, and I know what that reason is. You probably know what it is. Larry Leopard knows what it is as a PM. But most people that don't talk to PMs or deal with PMs don't understand this. When you're a PM in the US at a major mutual fund company, for example, I've worked for this industry for 25 years before getting into what I'm doing now with mining. Okay. These guys are and women are compensated based on their 1 year number, not on just their 5 and 10 year history. So they have to put up numbers every single calendar year. And when the S&P is so tech heavy, this is a problem for them, because imagine if you're a large cap core manager, right? Your job is to outperform the S&P, right? So as an active manager, how do you do that when tech is such a large part of the S&P? You have to take that risk on, or else you're going to be 5 to 10,000, 500 to 10,000 basis points behind easily. Like, so then you don't get a bonus at the end of the year, right? So like, this is the problem with the way we're melting up right now, is that people are starting to chase momentum. We saw it happen last year. It's happening again this year. It's a real problem that can unwind real fast. And if you don't believe me, go back and look at 08, 09. Go look at Washington Mutual. That stock was owned by so many, mutual fund companies of size like Fidelity, Vanguard, et cetera. And when they unwound that thing, it was like, boom, that whole sector just took it on the chin. It can happen real fast because selling begets more selling. And I would argue that 08, 09, the action, the price action then was way slower than now. We're dealing with algorithmic buying and selling now. This can happen super fast, and you'll wake up one day and you'll be down 7% in the S&P in a 5 to 10 day stretch, and you'll be like, "What just happened to my 401k?" That's really what's going to happen at some point later this year, I think.
Right. And one of the interesting things going back to Newmont, so Newmont's trading about $40. It was trading at $70 in August 2020. So it's down, almost, more than 50%, almost 50%, 70 to 35. So it has to rise, almost 100% to get back there, 80%, something like that, just to get back to even. And so Newmont nobody wants to buy it right now. Now, the reason why they would buy it is a hedge. They're basically saying, look, the risk off trade is coming. I can see around the corner. I want to have some risk off. I want to own some Newmont, like Stanley Druckenmiller and some of these other guys. That's what they're doing. They're basically saying, I want to get ahead of the curve here. I want to buy it early because I can see it coming.
Yep.
And Wall Street is saying, I don't have to get ahead of the curve here. I'm fine. Everybody, basically a lack of fear.
Yep.
So that's that risk on. I'm staying risk on. I'm staying there. I don't care. So today was a good example of everybody basically saying, I'm staying risk on. I'm not going to go over here. Now, one fear that they have is they're like, wait a minute, if I go and buy Newmont today and then the stock market does crash, Newmont might go all the way down to 35. I can buy it at 35. Why do I buy it at 40? And that is really a big reason why nobody's buying here at 40, because they think it's going to go 35, 37, 38. I can buy it cheaper. However, my theory is you buy to the bottom, sell to the top. So you take a position now, and nobody's doing this. Take a position now, it goes to 38, you add some more, it goes to 37, you add some more, and you're basically cost basing it down. And then when when it finally does take off, because it is going to, right? It is going to go to $80. It is going to go up 100%. And nobody cares about this 100% move, but they know it's coming, which blows my mind. I mean, the average person, if you really look at it and say, at a certain point, Newmont is not going to stay down here. Look at his chart. Because if you think that Newmont's going to stay at $40, then basically what you're saying is that the economy is going to come back. We're not going to go into recession, and nobody wants to own, and gold's going to go down. Now, that could happen, but the odds are better that gold keeps going up. And so Wall Street right now, they're not thinking like I'm talking right now. I'm just saying this is how they should be thinking, but they're not thinking this way.
Right.
And it's really fascinating because what I'm explaining to you is really what's going to happen. They're going to pivot away from risk on. And when they do, Newmont is just going to be a rocket ship, because that's when there's only so many places you can hedge. And when you're moving hundreds of millions of dollars, Newmont is, it's going to benefit from that movement, because a lot of money is going to be moving from risk on to risk off. So where do you go? And
right.
gold stocks is one place that you can hide, and a lot of people will go there. And so since people will go there, we'll start trending up. And once it trends up, then people chase the FOMO. It's like, for instance, Wall Street loves to have a stock that's going to go up 10 or 20%. They're buying, for instance, Apple. Everybody's buying Apple, and all you're getting is a 10 or 20% return, and they're buying the hell out of it for that little tiny return. So Newmont, go from 40 to 50 is a 25% return, I believe. So it's like, you know, they'll chase the FOMO once, but not until their mindset flips. Their mindset has to flip from risk on to risk off, but it's coming.
Yep. Um, just for listeners that may not know this, Newmont NEM is the largest holding in GDX, which is the largest ETF in our space. Newmont represents over 12% of GDX, and that is one of the reasons that GDX is lagging. Obviously, it's 1/8 of the entire ETF, right? So we need to see Newmont move. I think it's interesting that you bring this up, Don, because I was just interviewed on the Kitco main program with Jeremy today about 2 hours ago, and I was talking about Newmont and Dakota Gold DC as two great gold stocks, different, definitely different, of course, but both with great listings, right? That's what PMs are going to look for. They want to see a New York Stock Exchange listed stock because they have liquidity, right? They have penny bid ask liquidity, and that's what people are going to gravitate towards first in a rally, right? They're going to move into names like that. You can already see it with Agnico. AEM has a beautiful looking chart. It's outperformed the large cap gold miners. I would echo what you're saying about buying Newmont multiple times. We've done that over the years with many of our holdings, and that makes us unique because so many of my peers that I at least track buy something once, maybe twice, and they call it a day. That's a big mistake because you can't get entries right in this sector all the time. You just can't. So if you buy it at 40 or 40 and a half here, you can dollar cost average down, like Don said, 37, 38, get a blended, cost in the 30s, and then watch this thing take off because I think you want to buy it before the July earnings. If you look at April's earnings, they were pretty good. January was pretty good. You're only going to have a better earnings result with higher gold prices, which is really the first quarter, Don, don't you think, that we're seeing a sustained gold price at a very high level, and that will show up in some of these earnings.
Oh, absolutely. Yeah, the next quarter earnings are going to be great for Newmont, and then Newmont's going to benefit from gold prices trending higher this year and next year. And I think people are really ignoring it. I mean, my price target for Newmont at $3,000 gold is above 120.
Wow.
We'll see how high it goes, but yeah, I think it'll be above 120, and currently it's at 40. So I want to talk a little bit about the miners.
Okay.
Excuse me, I want to talk a little bit about gold and silver, my target ranges. So my thesis is that right now, gold and silver have made a run, kind of leading, if you will. Gold was running. It started late March and it basically hit a top, almost 2,500. And then now it's come back down to, mid 2,300s. And then silver got to 3,250. And I actually think that those runs we're pausing right now. And I think we're in a range. So I think gold and silver are kind of trapped here. So I see gold in a range from 2,000 to 2,500. And I don't think we're going to go down to 2,000. I think it'll be somewhere around between 2,100 and 2,200. So we're trapped in that range. And silver's trapped in a range 26 to 35. And again, I don't think we're going to go to 26. I think 28 will probably hold. But I do think we're trapped in this range. Now, what gets us out of that range? So we're going to get a cycle low sometime. I think it's going to be this summer, but the cycle low for me is basically the low for the year from now to till January. What is going to be the low from here to January? And I don't think we're there yet. I think we're going to have a lower low than we're at right now. But that cycle low, I think, is going to be much higher than the previous cycle lows. And so the previous cycle low in October was like 1810 on gold. We're going to be well above that. And so gold, that just shows you that gold is breaking out here. When you get that big of a jump in a cycle low, and the cycle low in silver is going to be a big, massive move as well. So you were almost at $21 for silver. Now I think the cycle low is going to be above 26. So you got these big, big jumps in cycle lows, which I think is really important. However, in order to break out, to get out of these two ranges where I think we're trapped right now. Now, when I say trapped, what I mean is I don't care how high this S&P goes now. If it goes, 5,800, it keeps going. I don't think gold and silver are going to follow it up here. I think gold was basically telling us a story when it went up as high as it got, almost 2,500. The reason why is because it was telling us a story that gold is needed as kind of a hedge, if you will, against the uncertainty that's coming. The dollar, a good example is the dollar is strong. The dollar is at 105. The dollar is up this week. It was all the way down to 104, and now it's at 105 just this week because of inflation. And gold has been strong. It hasn't went down. Normally, when the dollar goes up, gold goes down, but it's not. So gold's telling us this story that something bad's happening. So, but I think these gold and silver are trapped. But the thing that's going to flip it, what's going to get gold and silver out of get the cycle low in and then bust back out, that's going to be the stock market rolling over. That's my thesis. So I'm waiting for that stock market to roll over, basically sub 5,000. And you get to 4,800. I think that is when we pivot higher. So 4,800 on the S&P is when I think we'll get that pivot. We're going to get our next run. And that could happen, that we might be waiting weeks or months for that outcome. I don't know how long we're going to have to wait, but it could be a few weeks and it could be a few months.
Got it. Okay. Well, thanks for that assessment, Don. Anything else before we introduce Kyle?
Yeah, one final thing. I wanted to talk about the Michigan consumer confidence number that came out today.
Yeah.
And that's why I was talking about how there's this disconnect between Wall Street and Main Street. So consumer confidence number historically has been a good indicator of basically consumer sentiment in the economy. Normally when the economy is strong, it's at least 95 and usually 100. And then anywhere above 90, it's considered a fairly strong number. And once it drops below 90, you start getting weakness. And once you get into the 70s, it's significant weakness. Well, today we got a number of 65, which is pathetic. I mean, that's serious recessionary number. And Wall Street didn't care. It's just like,
No,
we don't care about Main Street. So I wanted to bring that up. And then Russell 2000 is the other one. I mean, the Russell 2000 has basically been flat since 2020. It's like, the S&P is like straight up and the Russell 2000 is flat, which is, Main Street again. There's a big disconnect. And the last thing I want to mention is everybody says that, oh, we don't have to worry about a correction. This is an election year because there was no correction in 2020 and there was no correction in 2016. So, hey, Don, and there's not going to be any correction. Everything's fine. And Wall Street has this mentality. But guess what, people? What happened in 2008? 2008 was an election year and we had a significant correction because
right.
That was going in. That's when the recession started. The recession started in 2008. And guess what? It's probably going to start in 2024 too. So I want to bring up those are my last 2 points.
Yeah, good. I'll just add that the Michigan sentiment number came in at 65.6, as you pointed out, and the estimate was 72. Huge miss. And for the market to be up on that makes zero sense. Secondly, you mentioned the Russell 2000. It's actually a very accurate indicator. If you look at even 2018, when we had that sell-off going into December, if you remember, the thing that let us down then and the thing that let us down in 2020 during the pandemic was the Russell 2000. So if you look at IWM, everyone, that is the largest ETF in the space, something I track every day. When you see that turnover, you know that the broad market may be in for a correction. And I think we're going to get that later this year. So thanks, Don. With us today is Kyle Floyd, who's the CEO of VOXR Royalty. The symbol is VOXR. It's on the NASDAQ. Really good share structure. Kyle is a large shareholder of the company, which I love to see. And I've known Kyle for about 3 or 4 years now and think very highly of, how he runs the company. And, he is shareholder focused, unlike so many mining execs. So, I really appreciate you coming on, Kyle. Thanks for the time today.
Yeah, much appreciate it, John. And Don, nice to be speaking with you as well.
All right. Thanks for being here.
So, Kyle, why don't you give us a 10 to 15-minute overview of Vox, and then we'll ask you some questions.
Perfect. Well, I'm going to assume a lot of the audience is pretty familiar with royalty companies and the concept, but at a high level, I'll give you the background on Vox, why we exist, why we do what we do. I think, in the royalty sector, especially, Don, I'm sure you would appreciate this. John, I know that you do. I think one of the first questions anyone should ask a royalty company is, well, why do you actually exist? Because the industry is competitive. There's more than one royalty company in existence today. So why are you here in the market, and what are you actually offering to investors that's of value? And that's a pretty harsh criticism of our sector in general, being the royalty sector. But I think it's relevant, and I think it's actually the starting point for a dialogue around what a company can offer its investors and why it's an investable business, kind of at a foundational level. So I'll start with that question to myself. And look, Vox was built to offer what we believe is the best risk-adjusted exposure in the commodity sector. We believe that we will generate the best risk-adjusted returns. It doesn't mean we're going to generate the best returns. I've seen some of Don's work, and he has a list of companies that he expects to do, 10x and more. It's not to say that we can't be that business, but when you factor in the risk and the potential reward and the potential value that we're continuing to build, we were built to create the best risk-adjusted exposure in the commodity sector, equities, commodity exposure. So that's why we exist. Well, how do we go about doing that? Our business model is different and unique from a lot of the entities in the royalty subsector that we exist in that we are a very focused buyer of third-party or already existing royalties. So it's a percentage of revenue typically from a specific asset or mine that was usually created between 10 and 40 years ago. So the most prolific example of this is a prospector that was out kicking rocks 35 years ago in Western Australia for us, and ultimately sells the land that they've staked to a larger mining company. In return, they usually get cash and a royalty. The cash gets spent 30 plus years ago. The royalty is their legacy and perpetuity interest in the revenue capability of that mineral tenure. That's what we go out and buy. And so we're not out there financing mining companies. We're not creating new streams and royalties. We're buying what's already in existence. And we built a business that's focused on serving our shareholders first and foremost. That's our fiduciary responsibility. But then also serving this part of the industry, which has these, for the most part, esoteric and illiquid assets that they've been holding on to for a long time. And we're providing liquidity to parties, groups, entities that need this liquidity around projects that we like and that we're optimistic about what the returns that can be generated for our shareholders. So that's fundamentally what we do. The benefit of that is that we're not the mining company. When you buy a royalty company like Vox, you're buying what is an undiluted interest in the revenue capability of these assets, typically uncapped. We do have some capped royalties in the portfolio. Usually they come along with portfolios of royalties, so we're not targeting those per se, but usually uncapped, and gives you that optionality to the success of these projects over what can be very long-term time horizons, where you can see metal price appreciation, discovery potential, increase in reserves, and what we often see is modular increases in production as well. All of that compounded when things are going the right direction. So that's what we focus on buying. And fundamentally, to allow us to buy these assets at good valuation, you need as many shots on goal as you possibly can have. You need a proprietary ability to find these assets, ultimately what builds our competitive advantage. And also, principally at the front lines of our business, technical folks that really understand the technical elements of these assets, both the risk and the upside. And so we built a company, just like, I think if you were going to go build another company, John or Don, that it needs a competitive advantage, it needs a durable basis to create value for its shareholders. We built around kind of three key stools, or legs of the stool, if you will, that allow us to kind of have an engine that is sustainable in its value creating capability. And so the first part of that's our team. That's the technical, that's the mining engineers and geologists. They're evaluating developments over projects all around the world every single day in volume. The second thing is that we both built and bought the world's largest proprietary database of royalties. So when we bought this database, it was called Mineral Royalties Online out of Australia. The two founders of that business are part of Vox, Spencer Cole and Rian Easterhuizen, former BHP. And so that was 7,500 royalties. It's now sitting at over 9,000. And that gives us insight into who owns royalties around the world that we could potentially be a buyer from. And then the other key piece of the stool, if you will, in this metaphor, is that we're screening for information that indicates that an asset is going to be successful. And that can take the shape or can take different shapes and different forms. And I don't really get into what that information is because that's very much part of our secret sauce. But we're looking for, on an event-driven basis, for assets that we feel really good about from a technical perspective, from a growth perspective, and that we can find in the database that, for the most part, no one knows about. Evidence of this is we bought royalties from hollowed out mining shells that are now telecom businesses, hearing aid technology businesses, automotive parts companies, doctors in the west coast of Africa, family offices, estates, to the major mining companies like First Quantum and metal traders like Trafigura. So that's our business. We find these third-party royalties. It entitles us to a revenue, a piece of the revenue that these assets generate. It's a non-dilutable interest. And it allows us to participate in all the upside and things that mining companies do well and can realize on, but insulates us from a lot of the challenges of the industry and a lot of the risks of the industry. And so that's where that risk-adjusted return comes into play. We have I think, one of the best track records in the sector over the last 5 years. We can talk more about that, but ultimately, that's why we exist. That's what we do. We're definitely different within our sector. And I think we provide a very, very helpful kind of component to the ecosystem of success in the mining industry. There are a lot of groups that need to realize liquidity on these assets to keep going out and prospecting and generating new assets that will ultimately become new mines. And so that's Vox Royalty Corp in a nutshell. For the viewers that don't know, we trade on the NASDAQ and the TSX. TSX main board, about $100 million market cap. We've been public for about 4 years now. We pay a small dividend, cash flow positive, and mostly exposed to gold within our portfolio, but there's a handful of other exposures between base and industrial metals, and that's Vox. So hopefully, John, that was helpful in terms of giving everyone an overview.
Yeah, absolutely. I'll kick it off. When I picked up on there is that one of your differentiators is your database of the 9,000 royalties. So how did you come around to that, as a business plan, and how does that, if we can dissect how that separates you from other royalty companies, that would be helpful.
Yeah, it goes to the genesis of Vox. So we raised $7.5 million in 2013, 2014 to start the company. Prior to that, don't hold it against me, I consider myself a reformed investment banker, and have become very much a value-focused investor and allocator of capital. But I saw all the issues with the industry. I saw how difficult it was for generalist investors to invest in the sector without, the shepherds that John, you are, and Don, you are for the industry and for investors. It's a tough space to understand, and ultimately spent a lot of time with the royalty companies that were kind of emerging royalty companies back then, and they did a lot of things right. In my opinion, they did a lot of things wrong. One of the things that was wrong with the industry is, going up to that opening question: why do you exist? How are you offering a better or a different exposure than the other 35 royalty companies that exist today? And a lot of these businesses were not shareholder aligned either. So it was all about growth at any price, much less about returns and alignment with shareholders. And so I approached a group of investors and said, look, I think we can build a company that synthesizes the best qualities of royalties within one company, be disciplined around that. And key is, it doesn't matter what kind of assets you're buying. If your entry price is always wrong, you're not going to build a good business, in my opinion. And so we needed a competitive advantage to be able to find assets that the rest of the world didn't know existed, and provide a service to the other side of the industry, which is typically a prospector, a mining company that's owned this asset and has since sold it, and be that provider of liquidity into the ecosystem. And to do that well over the long term, we needed a competitive advantage around that. And I believe that there were a lot of forgotten royalties. We started building our own database. This was back kind of 2016, 2017. And at that time, I found Mineral Royalties online in Australia. So that was Spencer Cole and Rian Easter, who's in, and they had built the world's largest proprietary database after basically doing the same thing for BHP, focused on BHP's royalties. And so they found approximately 100 royalties and tens of millions of dollars of past due royalty revenue that was owed to BHP, consolidated those assets that had been forgotten and not cataloged within the large business that BHP is, and ultimately found royalties that are worth between $1 billion and $2 billion that BHP has kind of monetized now. So they, on a global database basis, built up what is now purely Vox's and entirely RIP. And but it was from that experience with BHP that they saw how royalties could essentially be lost and forgotten about. And if someone could go out there and accumulate, a vast percentage of these types of assets, that would be a huge competitive advantage. And so we agreed, and we found them, almost 6 years ago now. And it's been a key part of our value creating engine was this database, and we continue to build it. So we invest in it every single year, and we find more royalties that we didn't know existed.
Okay, I have one more question, then Don, I'll turn it over to you. So I'll lead with a comment. Last year you did a financing. I know we talked after that, and I asked why you were doing that, because the stock had momentum at the time. And you had said, I can't really talk about it, but we, constantly are looking at deals. And then in September of last year, you had really good news. I believe that Australian portfolio that you purchased was found through the database, or was it not?
It was frankly a royalty that we've known about for a very long time on an event-driven basis. We saw some really positive news around it, and it was amongst 8 other royalties. And so it was kind of the perfect storm, so to speak, for us to go and find really, really deep value and buy what Cormark is an analyst that covers us for whatever that's worth. But they've identified this as what is capable of being a top 15 gold royalty in the world. And very few of those are held within, outside of the majors, being Franco Royal and Wheaton.
Okay, and what did you pay for that in September, and what do you think it would be worth conservatively?
So the entire portfolio is about 5.3 million, which this was a component of. Look, this is a little bit forward looking, based on the data that Northern Star has put out. I know Don's well familiar with Northern Star. They're the largest producer of gold in Australia, who is the second largest exporter of gold globally. Absolutely, very meaningful player in the gold scene. And what they put out publicly, if you kind of do the math and run it out, we believe that this asset will do $10 million a year for us on average, for what will ultimately prove out to be more than 10 years. We believe this asset's going to be worth $50 to $100 million, maybe more. We expect it to be in production some point in 2026. And it's one of the world-class gold royalties that exists, but it was absolutely found because of the database and the things that we screen and look for on a daily basis that gave us an edge in pricing this asset.
That's great. Well, I can say, just for myself and my clients, I know you and I met at Beaver last year, and I think the news came out that week. We were definitely buyers then, and I think the stock was around 215, 220 a share. It isn't much higher right now. I think it's in the 240s. But the fact is, the markets, in my opinion, just miss things like this. I mean, it's very easy for people to overlook good news. I think if it's not a drill result, where it's getting marketed by a company, sometimes you have to look at these deals more carefully. And I think that was a tremendous acquisition. So Don, why don't I turn it over to you, and you can ask some questions. I don't want to hog this.
Yeah, thanks for being on, Kyle. I definitely have a lot of questions. I'm actually going to start with kind of the red flag, kind of the elephant in the room, is you're undervalued. I don't know if that's a red flag. In 2020, when you were listed on the NASDAQ, you were listed about $2, and you're currently at $2.40. That's only a 20% move. So, there hasn't been a lot of excitement in your stock. But if you go back to when you first IPO'd in 2014, the company's grown a lot since then, over 10 years, but in the last 5, it hasn't done so well. Now, what was your free cash flow in Q1, the last quarter? Because usually the multiple on a strong royalty company is about 30. And you're currently about, I have you fully diluted US 144 million. So what was your free cash flow in Q1, the last quarter?
So last quarter, I believe we were around 1.25 to 1.5. You're catching me off the cuff, but we're in that range and targeting around $5 million of free cash flow for the year.
Yeah. So that's about right. So I mean, 5 times 30 is 150. So you're actually valued, not super undervalued. So that's actually a red flag. So now we need to figure out how you're going to grow your revenue. So you're valued actually kind of, I mean, not super undervalued if you're expecting 5 for the year. That's kind of what the market's valuing you at. It's actually showing that investors kind of like your company to give you that kind of evaluation. They're expecting it. So what is your projected revenue growth in the next 3 years? What percentage revenue growth are you expecting?
Yeah, and so candidly, we expect flat growth or relatively flat growth this year. Same guidance as we gave last year, but that's on the heels of 360% revenue growth over the last 3 years, 130% consecutive cash flow per share growth in the last 2 years. So we've had kind of a pretty big leap forward in terms of the profitability metrics and cash flow metrics of the business. This year, we always knew it would kind of be a stair step. We didn't artificially solve to keep kind of I would say, that growth rate. And that just happens with projects and how they ultimately come online. We're looking for value first and foremost. So we're not looking to solve for a perfect trend line, if you will. Sometimes it plays out, sometimes it doesn't. We're having kind of a stair step year in terms of revenue growth, where we expect 2025 and 2026 to be pretty big growth years for us. So Don, we haven't given guidance for 2025, 2026. On average, analysts have us growing meaningfully in 2025 and then very significantly in 2026, especially with Red Hill expected to come online kind of in that time frame. So our next 5 assets that come online are Western Australian gold. We have pretty high confidence level.
Right. So how do you think you compare to your peers as far as revenue growth, say the next 5 years? How do you think you compare?
Look, I track the peers enough to be somewhat fluent in what they're doing, but I'm not so fixated on, well, one, who's the peer group? So we'd have to kind of define who that is and what their expected growth rate. That's a tougher question for me to answer. But look, I would say I'm very fluent with what our growth profile looks like. And what we focus on, Don, is return on invested capital. And what have we put out? And what are we expected to generate both on a per annum basis and then going forward? So what I can tell you is, you said, look, the market's kind of fairly valuing you based on the multiples ascribed to the major, more established mining royalty companies. Look, our growth rate is going to be a lot higher than them. And I can tell you, on average, I think when I've seen research analysts cover the majors, I think the average growth rate is flat to maybe 7 to 10% in the case of someone like Wheaton, who's probably growing a little faster than the other majors. But we're growing a lot faster than that. Analysts have us going from, we did about 12.3 top line last year to somewhere between 20 and 30 as you get into 2026. So that growth rate's obviously much more significant than the majors. It's easier for me to talk about the majors because their numbers are more consistent. And I probably pay a little bit more attention to what they're doing and how they're advancing their businesses than maybe some of the peers in our industry. But I can tell you our growth rate stacks up very favorably.
So your business model, I'm making an assumption. It's actually stronger than some of these other royalty companies because you're actually not going out and loaning money out to companies. Companies aren't coming to you and saying, look, I need $30 million. Give me 30 million and I'll give you a stream. You're not doing that. And so that it lowers your risk. You don't have to borrow a bunch of money. You're not a bank. You're just going out there. So that, for me, my assumption is that means that the vast majority of your income are from NSRs. Is it 100% coming in from NSRs, or it is? Well, okay, that's good, because I believe that the streaming model actually has a problem, and I'll explain that problem. But I want to talk about your.
Well, I can almost guarantee you we agree on that. I don't know what Is it?
I'll explain.
I have a hunch we agree.
We probably will agree. I think stream model has a problem, but you don't. In the NSR model, I don't think has a problem, because those contracts, everybody's comfortable with them. I mean, that's there's no problem with the NSR model. So that's great. And so you're going to basically just keep expanding your revenue through that model, and that's going to lower the risk of people owning your stock. And so as the price of gold goes up, the reason why I was talking about revenue growth, you're going to get revenue growth just from the price of gold alone. And you started in Australia, so you're overweight gold and not so much silver, because there's very few silver royalties in Australia. So
you cover one. So we have silver mines. We have royalty over Bowden's. They're
nice.
We're excited about. But
yeah,
you're absolutely right.
Very excited. So from that perspective, gold's going to go up, I believe, significantly over the next, say, 2 to 3 years. So you're going to benefit there. You'll get multiple expansion because your margins will stay very, very strong as the price of gold goes up. So that's a really good model. And you said, yeah, it's unique. I actually like that model a lot. So overall, you're kind of a boring play, if you will, but it's strong. I mean, it's definitely going to make money. It's one of those it's really difficult as an investor, though, to value you, because you're not, super aggressive. You're kind of a conservative. You're picking your spots, if you will. You're not going hog wild. One thing that you didn't mention that I'll mention that people don't know is you currently have zero debt. Correct? So right. I really like that model. I'm a cash focused guy. I like companies to have zero debt and a lot of cash, because it gives you so much flexibility. Once you have a lot of cash, you can buy stuff, and you can buy back shares, you can pay out dividends. It gives you a lot of flexibility once your cash grows. Get that cash to 50 million, 100 million. It gives your company a lot of flexibility. So I like that. You've been in business for 10 years and you don't have any debt. So that shows me that is your strategy, which is great. You're not about, you're a conservative company. So let's go to the model. I get in a lot of trouble when I talk about why I believe that the model is flawed. And I was going to bring this up to you and ask you, because if you had any streams, my question is, when does the streaming model break? And people say, well, it'll never break because it's a contract. But let me I'll give people an example. The reason why I say that the model's flawed and it will break is, I'll give you an example. So when those contracts were created, those contracts are fixed for the life of the mine. And so nobody expected gold and silver prices to get to a certain level where you had this huge, huge discrepancy between the borrower and the lender. So for instance, let's say that silver goes to $100. I'm going to give you an extreme, if you will. Silver goes to $100 and you have a fixed contract at $4. So that means that the lender's getting $96 in profit for every ounce. And the cost, let's say the cost went to $20, the borrower's losing 16. Mm-hmm. So for every ounce, you're losing 16, you're gaining 96. Do you really think that contract's going to hold? There's no way in hell. There's just, you're just not going to make, because the reason why there's no way in hell is this, and I'll let you comment, Kyle. The reason why there's no way in hell is this, is because you have so much leverage. The person who's paying that $96 to that other company, you have so much leverage. I mean, they're making so much profit. It's unbelievable, right? Huge, huge leverage. You just stop paying. And the other side's going, well, I'm taking you to court. Fine. You're not going to get paid for 6 months, right? I'll pay you. I'm going to pay you. Maybe I'm going to pay you a penalty, but I'm not paying you for, let's see how long it takes for this to get resolved. Let's say it takes 6, 7, 8, 9. During that whole period, you're not making a penny. And on top of that, you have to tell your investors, we got a legal issue. We're not getting our income. Mm-hmm. The board's going to go fix this problem, right? So that's what's going to happen. And they're going to fix the problem. The way they're going to fix the problem is a few companies are going to renegotiate the deals. And once you have a few renegotiate, it basically it's a domino effect. Everybody starts fixing these contracts. That's my point. At a certain point, I don't know where it is. Is it $50 silver, $75 silver, $100 silver? Now that's the silver has where the problem is dire, if you will. I mean, that's where the bomb is ready to explode. But in gold, it's the same. The same problem exists there as well. But we don't know when the flaw basically exposes itself. But at a certain point, it blows up. Okay, I'll stop there and let you comment.
Yeah, it's a little bit of an unknown. Where we've seen, you're not wrong. There has been a lot, I would say on average, about 50% of the streams that have come into existence have been renegotiated, maybe more. I might be low on that estimate. And unfortunately, where it's typically been renegotiated, because we really haven't had that explosive outbreak in the metal prices or breakout of the metal prices yet. So we haven't yet seen how that holds up, but I don't disagree with you that is a potential risk. We've certainly seen renegotiations on the downside. Hey, the mining company is struggling cash flow wise. Things haven't gone as well as expected. There's asymmetry in terms of the return that the royalty companies expected versus the risk that they have. So there's been a lot of reasons for all those renegotiations, and it ultimately doesn't really work in favor of the streaming company on average.
Right.
So you're not wrong. The only thing is we've seen that on the downside scenarios, not yet on the upside scenarios. The upside scenarios, yeah, I mean, that is a real risk. And I think one of the issues with streaming is it can be such a large percentage of the revenue of an asset, and it really strips the upside away from the asset versus our average royalty is about 1.1% of the revenue.
You're not exposed to it.
No, and that's probably, that's where we want to be. We don't want to be a drain on an asset. That's not good for anybody. So we're going to have a lot more positive exposures we have 70 royalties in our portfolio, but yeah, we're not taking 30% of the revenue that an asset's generating.
Right. Thanks for that answer. I need to follow up with this because there's going to be a lot of people that own royalties because you are a royalty company. And so people are tuning in and they not only own you, they own other royalties. So I need to follow up on this because most royalty companies do have streams. I am very bullish the royalty model in the near term. The model's not going to break down in the near term. I'm a big Wheaton. I like Wheaton a lot. I think Wheaton is going to do extremely well for a while. So in the near term, I think until silver gets above $50, I don't think anybody's even going to be talking about problems here. I don't think the problems will start to poke their head out until we get above $50 silver. And then I think that then people will start talking about it. So if you own royalties stocks, I don't think you have to worry in the near term. I don't think they'll get hit, if you will, or, like I said, I think people are going to buy them. They're going to do well. I'm very bullish on the royalty model in the near term. So I'm not totally bearish on the whole model, but I just think that at a certain point, I don't know where that's at a certain point, it becomes flawed. And Kyle even mentioned it, that I was really shocked when he said 50% of streaming deals have been renegotiated. After this is over, you might say, "Oh, I'm not sure I should have said that." I didn't know it was nearly that.
It's just the truth, and it's it is what it is.
Because from my understanding, those deals, when they get written, especially like Wheaton or Franco, when they sign their name on there, they expect that thing to hold for the life of the mine, right? Now I wanted to make one final point. I told you I'm not bearish in the near term. I think they're fine. But here's the risk that you need to consider is that when these deals, if they do get renegotiated, they're going to come out of left field. And so what's going to happen if it's a big streaming deal, you're going to wake up in the morning and there's going to be a news release by one of these royalty companies that they're in negotiation. They're in negotiation to renegotiate a streaming deal. When that happens, everybody's going to go, "Oh my gosh, which one is it? Which streaming deal is it?" Right? They're just giving everybody a heads up once it happens, right? When that happens, that stock's going to go down 10% in a single day. So that's where your risk comes in. It's like you're thinking you have a low risk investment. I have a low risk investment. It's going to trend. Gold's doing great. And then you wake up the next morning, gold's up $25 and your stock's down 10%. What the hell just happened? That's the risk you're taking at a certain point. And like in the future, at a certain point, I don't care which royalty you have, that there's a possibility you wake up and it's down 10%. That's the reason why royalty stocks making me a little nervous. And that's
and look, there's been a couple of these renegotiations. Royal Gold announced one recently. I was just looking to see what asset that was over. I know, I'm pretty sure Triple Flag over, I think it was Nevada Copper, had renegotiated a couple times. And look, they're not the only ones. There's a lot of renegotiation. I haven't seen it. It has happened on the upside. I'd have to come back to you with the examples of that, but by and large, you're not wrong, but we haven't seen it truly impact the industry and its valuation yet.
No.
So, and look, I think $50 and $100 silver is going to be a great problem to have.
Right.
And I think, ultimately the one slight disagreement I'd have, I wouldn't even call it a disagreement, is I think at those valuations, everyone's going to have been such a home run grand slam winner that renegotiating a stream or a royalty, it would be a stream in that context. At that stage, it probably doesn't make you a loser. But yeah, it probably limits the upside that maybe some expect within that model. And I would agree with you on that.
That's kind of where, I didn't bring up that point. My point is that once if it starts happening on a frequent basis, like you mentioned about three companies that have had issues, but where it will kind of become a problem, if you will, is if it becomes pervasive. In other words, we start seeing one of these are happening every single month, something like that, and it becomes more pervasive. And the other thing I wanted to point out was, and you basically said is that people think that this is a trend, okay? And then this is the key to it all, is that currently the margins for the free cash flow margins are very, very high for royalty companies. I mentioned 30 is about the average that I've seen. It's possible that the entire industry, the margins come down. Now because you don't have any streaming deals, your margins might go up because you don't have the risk. People I'm going Vox, they don't have that problem, but everybody has these streaming deals. I'm giving an example. For instance, right now, the way the deals are written, and this is also conjecture, but I think what could happen is that one company could literally redo the whole model. And what that model would do, they basically come in and they say, look, we're not going to do fixed. We're not going to do fixed anymore. We're going to basically say, look, we're going to use the price of gold, the price of silver, and we're going to basically base it on that. So gold goes up, then you get more money, basically. And they redo that model. If they redo it to a certain extent, if the model gets redone, if you will, then margins could go from 30 to 25.
That's happening, Don. It's happening. And anyone that's in the streaming business has restructured a royalty or a stream. Sorry, royalties don't need to be restructured, as we talked about. But anyone that's in the streaming business has restructured a stream. And again, I think 50% is low. And what I've seen recently in streaming deals is it's no longer like when Wheaton came out, and in a lot of ways, Wheaton has done some really clever things and been, I think, ahead of the curve. And I, not a plug for Wheaton, so to speak, but I think they've got some of the best growth in front of them in the industry. And I don't have a dog in that fight. That's just my external viewpoint on monitoring it. But one of the things that they did is, they originally had a fixed price. It was $4 silver, $4 for silver. That was when they came on the scene in 2004, 2005. The problem, though, was it was a very arbitrage-based business. And what they figured out was if we can take byproduct from a copper mine and take their silver or take their gold, ultimately, we can ultimately trade at a much higher multiple. So we can pay 7 to 10 times cash flow and hope to trade at 20 or 30 times cash flow on royalties. And that actually, I think, started the problem in our industry, which is everyone just thought it was a really easy business. Just go buy arbitrage. And look how smart we are for our investors. We bought cash or royalty revs at 10 to 12 times. And look, we should be trading at 20 to 30 times, ultimately driving returns frankly, not to very unattractive levels, in my opinion. And certainly not attractive when you've actually priced in some risk that was present on these assets and in these situations. So Wheaton is very well positioned, and they started a very interesting model. But now we're starting to see that the streaming contracts are no longer fixed prices. They're a percent of where the metal's trading. So you're absolutely right. The margins are going to be compressed. One of the interesting things about Vox is certainly within our peer group, we have the highest margins in the industry. And it's because we're buying assets well, and we don't have this, pay per ounce structure that the streamers do. And so you're going to continue to see margin expansion from Vox versus margin contraction, because the issues that you've, very, cleverly kind of, I would say, isolated, that are going to affect a lot of the streaming, more streaming focused businesses that are out there.
Right. Yeah, absolutely. So the key to your business from my perspective is going to be revenue growth. And when I say revenue growth, I'm not talking about gold going up. I'm talking about new royalties, right, coming online. But if you can do that, I mean, you're going to be successful. I like the fact that you have 9,000 royalties that you're doing research on and try to identify them. I love the fact that you mentioned silver mines. I just think that's going to be a fantastic royalty when it comes online. I'm a big fan of that company and that project, because I think silver prices are going up, and Silver Mines is the only large silver mine in Australia. So I think it's going to get a huge premium over time. I like the fact you got a royalty with Northern Star. That's awesome. So overall, I'm rooting for you, Kyle. I'm rooting for you. I like what you identified. You identified a business opportunity in 2014. Actually, you basically did your IPO in 2014. So you identified it basically right when the market right?
I IPO'd in May of 2020, May 25th. Was the date that we IPO'd. So we were private for a long time. And one of the things that I would add is, when you look at our cost structure of our business, we're about $5 million of cash cost. And you look at our peer group, I won't say who those are. I'll let you and John be the determiners of what the appropriate peer group is. But I can tell you that our margins are higher than what we consider our peer group to be. Our costs are lower significantly than what we consider our peer group to be.
Right.
And being private and steeping, one of the benefits that we had, and I didn't realize this until being CEO of a public company, is you end up taking the shape of your investor base. You shape it to start with, and then it kind of shapes you as well. And we had really patient, value-focused investors. And it wasn't ever, hey, go win an arbitrage game, because we believe that arbitrage gets priced out of pretty much any system at some stage. It was, hey, how are we going to go out and create fundamental value for our shareholders? And how are we going to continue to build the advantage in doing that? And so being private and not having the Mr. Market, as Buffett would say, he uses a different context, but I'll say beating you over the head every day, asking for quarterly results. It steeped a very long-term value-focused mindset with us. And I would say that's very different from a lot of our peers that went public very quickly, had to produce growth in the wrong way. So yes, to your point, we're going to generate revenue growth, but we're going to do it in a very value-focused forum that allows us to generate the right returns around that.
Right. As far as peers, I actually put all the gold and silver royalty companies together. I don't think there's really any difference between you and Franco-Nevada, which has the largest. I really don't. You're both basically doing the same thing. I don't see them as having an advantage over you in any way.
I'd love to have Franco's balance sheet.
Right. Yeah, but in many respects, you have less risk than they do. So I don't really. So a lot of times, like, people will buy Newmont because you're going to get your dividend and it has less risk if you're going to compare. But for the royalty, I mean, myself, I actually put you all in the same bucket. If you're a gold and silver royalty company, I think you're all basically doing the same thing. I just don't see them. For instance, neither of you guys has any control over mining companies, what they're doing. You just own a contract. That's all you own. You own a contract. So if that's what it is, then the business model is I own contracts, then you're all the same. It's just the way I look at it. Oh, I'm done. That was my last John Stern. But thanks for being on the show. I really enjoyed it.
Yeah,
So
no, that's great. Kick it over to you, John.
yeah, just following up on that point, Don, I understand what you're saying about the compare and contrast with Franco. However, when you look at the P to NAV on Franco, it's one of the highest in the royalty space. The last I looked, as of March 31st, and when you look at Kyle's P to NAV, it's one of the lowest. So it's interesting as a value. We're both value oriented, investors. That's one of the things that struck me is that when you look at the peer group, and there's a slide on voxroyalty.com, if you go to the corporate presentation, you can see this. That is pretty telling. It's like they're one of the least well, Kyle, you can probably say it more,
I would
more
say
eloquently.
trading at the lower end of the relative valuation multiples in our sector. And look, yeah, Franco, if you can look, good royalties trade at 2x NAV. That's what we're seeing in the private markets. That's what you're seeing transactions happen. Trident just got acquired in our sector a couple days ago, 20x for royalty revenue, if not more than that on a pure royalty revenue basis. And that's just how royalties are trading these days. So credit to Franco for achieving that multiple. They've held it for decades now. And they've got a great business. They've got great assets. And, one of the things that I think gets overlooked in our sector, Don, which I know you'll appreciate, is management experience and how long you've been doing what you've been doing. In this sector, it matters. I would tell you when I started Vox, I didn't know what I didn't know. And thankfully, we had the right core principles that we were building a business around, and patient shareholders that allowed us to go build a business, in my opinion, the right way. But experience matters, and Franco and Royal and Wheaton have that, and they have more of it than any other royalty company. So I give them credit in that context, and that it does matter in our industry. I think we have the most within our collective team for any royalty company sub $1 billion in terms of true royalty expertise and experience within this market. And it allows us to find better assets ultimately. It allows us to find the assets that are going to really generate the right kind of returns for our shareholders. And I think we've demonstrated that track record. One of the reasons why I'd be curious what Don thinks about this, but one of the reasons I think that we're undervalued is we have the largest holding on a relative basis of royalties in Australia. Franco has more, which we're close to them, but we, on a relative weighting basis, we have by far more exposure to Australia than any other royalty company. What we see on Red Hill, we don't get full valuation credit for that asset. I think it could be worth the entire market cap of our business when it's all said and done, versus other companies in our sector have an asset in Nevada or Ontario, Quebec, and they get full value for that almost immediate, let's not say immediately, but earlier on in the development phase of that asset. But it's almost like we have to educate on Australia a little bit more. And because it's so far away and out of sight, out of mind a little bit, I think that actually drags our multiple down. And one of the things that we're working hard to do is to extol and elucidate the benefits of Australia and owning royalties in Australia. We believe it's by far and away the best mining market to own royalties. Combination of great people, great operators, great infrastructure, great geology, great rule of law and precedent around our asset base. And capital in abundance for Aussie mining cos, like nothing you see in North America. So we believe we have the best portfolio weighting you could have in the industry with our strong dominance in Australia, but it's actually working against us right now in terms of relative valuation. And I think it's a big opportunity for investors. If they do the homework and look into the benefits of it, I think most would agree that Australia is probably the best place to own royalties.
Can I comment on that, John?
Yeah, go ahead.
So I've been trying for, I would say years, trying to get people to recognize the value of owning miners in Australia because of the location. The location risk is so much better than other places in the world. I think that investors, when we do get a gold mania and we do get gold fever and and the sentiment comes back into the miners, I think people are going to look around and go, where can I buy a gold miner in a good place? Like, look at those Aussie miners over there. Mining is into Australia what farming is to the US. I mean, it's like the bread and butter. The two countries that are basically mining countries is Australia and Canada. I mean, that's what they do. They mine. And I've been trying to tell people, I've been collecting, I've been buying Aussie miners, as many as I get my hands on. I'm actually frustrated. There's a few that I don't own because I won't overpay. Like, and they're just too pricey. I've just been waiting forever to get my hands on them. I like to own every single mid-tier in Australia, but I don't own them all because I just don't want to overpay. So you are absolutely right. You are undervalued because you're in Australia, and all these companies are undervalued. They're just, and the reason why, I give you an example. I do coaching to help people, to understand how to analyze mining stocks. And I did a guy this week, and he gave me a list, and he had 50 stocks, and they were all great. He didn't have a single dog on his list. I couldn't believe it. He was a fantastic stock picker, but yet he didn't own any Aussie stocks, not a single one. And I mentioned it to him. And the reason why is because he doesn't want to buy them on the Australian exchange. And that's what happens. People, around the world, they see that, they don't want to go and buy them, or they don't want to pay extra. A lot of times, like that, if they go through their brokers, they have to pay extra to own them. But I tell them, you can buy them directly on Aussie, and you don't have to pay extra. So I basically coach them on how to do it. And so you're right. When things turn, the premiums on these Aussie stocks is going to go through the roof. I mean, this is going to be like the 1980s. In the late 1980s, the cash flow multiples went absolutely bonkers in late 80s. I mean, 1980, late 1980, early 81. They went bonkers. And that's, I think, going to happen in Australia, where people are going to pay a premium for these things. Heck, they're already paying premiums for some of these. I mean, if you look, some of these stocks are trading, that's why I don't own them, because they're a little pricey in my view. So some stocks are already getting those premiums. I think they all will. So you're absolutely right. You're getting undervalued because of that Aussie exposure, but it's actually a benefit. So you're undervalued. That's why that NAV is so low. And my final point was this, is that I actually prefer you over Franco. I mean, in a risk reward scenario, because I just don't see Franco really growing that much. Wheaton, I love Wheaton because they actually have a growth story. It's actually big, but it's growth. So I like Wheaton, but comparing you to Franco on a peer basis, I'd rather own you. So that's my final comments.
Well, thanks, Don. We'll take those comparisons any day. So appreciate that. But yeah, Franco's a great business, and a world apart in terms of market cap and scale. But no, appreciate that. That's very kind words. And we agree on Australia. It's really, when you look at the combination of quality geology, quality operators, infrastructure, it's really a tough market to beat. And what the other thing that I think we'll see is, like you said, Canada and Australia are the only truly quality jurisdictions to be in that have mining as a part of their DNA still. And what I think where that's going to materialize positively for those jurisdictions, and especially in Australia, is cost of labor will be relatively lower because they have a higher percentage of the labor force involved in the industry. And not to say that they won't experience cost inflation, but I think it will be less than what you see globally. And I think it's a big function of that population still wanting to be miners, embracing the industry. I don't know. I'm in Denver. I don't know how many, let's call it, I don't even know what the generation is anymore. Is it Z? Is it? But I don't know how many of that generation, let's call it in their mid-20s, coming out of university or even before going to university, are wanting to be miners. Like it's just such a small fraction of the population for the amount of assets that we're going to need to keep up with demand. I see cost inflation being somewhat out of control in the US. Canada will probably manage it a little bit better, but I think Australia will manage it the best.
Interesting. Well, thanks for coming on, Kyle. We really appreciate it. I think everyone should take a look at this. As I mentioned, VOXRoyalty.com is the website, and check out the presentation deck there. I think they do a really good job of talking about, many different aspects of the royalty business. And I think you'll learn something, if nothing else. Kyle, can you just, in closing, just tell us, what your percentage is in terms of ownership? I know that's something that Don looks for in terms of, management, board, et cetera.
Oh yeah, I have their insiders I have 65%, Kyle.
Well, when you take founding shareholders and management position, and then Gold 2000, Conwave is one of the largest hedge funds buying value focus in the gold industry, buying gold stocks. They own about 7% of the business. So Yeah, we've got a great insider ownership. That's both hard dollars in, it's not just equity earned along the way. So 11% for management, still about 40% from our founding shareholders. And then when you look at the combination of kind of the major institutions that own us, yeah, you get up towards 60+% of the register. And so, as Don said, no debt, cash flow positive, a lot of organic growth in front of us. And we're just really disciplined in what we do. Don said,
Tightly held too. They only have 50 million shares out right now.
yeah. And, Don, you said it could be construed as a little bit boring. And I've actually apologized for that on interviews in the past, because we just keep doing what we're doing. We believe we're finding and building great value for our shareholders. We put our kind of head down and work hard, and, it continues to build value. So yeah, it can be construed as a little boring, but I think it's a great business.
It won't be boring if you start buying back stock.
Don's a great, John probably has to wrap us up, and it's probably a segment for another day. The problem is that we're trading at, I don't know, 0.4, 0.5, 0.6 times PNAV, depending on whose numbers you want to use. We're finding assets at better prices than that. And so we want to continue to fuel that accretive growth. But we also recognize that our share price is still very much undervalued in our opinion. So it's a great debate and great question for another day.
All right. Awesome. Thanks, Kyle.
Yeah, my pleasure.
Thanks for coming on, Kyle. We really appreciate it.
All right. Thanks, guys. I'll leave you to it. Appreciate it.
Of course. Thank you. So Don, what are your thoughts?
Yeah, it's got a lot of positives, right? I mean, tightly held, 50 million shares, no debt. Management team's been doing this since 2014, slowly plugging along, slowly growing the company. The only red flag here is you're gambling that the stock's going to perform well. I mean, it checks all the boxes as far as the royalty model goes. Doesn't really have any red flags other than nobody really likes the stock. It hasn't really performed. I mean, it's up 20% in 5 years. It's like, why should I buy this thing? Why should I own it? But that said, it's got a lot of underlying strength. It's got Australia. It's got this cash focus, tightly held, huge insiders. It's got, for instance, somebody calls them up and says, well, we want to buy your company. We're like, we're not for sale. We're fine. It's got a lot of positive. Like I said, the only red flag I see is, what kind of return are you going to get? Are you going to, if I own Wheaton, I know I'm going to get good returns.
Mm-hmm.
Not sure if I'm going to get that with Vox. That's the only red flag here. You have to kind of believe that this company is going to keep growing and keep getting bigger, and it's in surprise to the upside. And then Australia, at a certain point, like that PE to NAV, at a certain point, it's going to expand. But on the whole, it's hard for me to get super excited when he doesn't. That one rep, because I'm always after alpha, right? When he can't tell me, what our growth is going to be like over the 5 years. This thing would be a slam dunk if he said, we're going to grow at 25% revenue over the next 5 years. If he said that, I'd be all over it.
So I think let's talk about that, because we didn't have time to ask him much more there. I had done my homework on that. They have 6 producing royalties right now. They're going to have another 6 to 7 by the end of 2026, one of which is the Red Hill project he talked about, which is a monster. I mean, they picked up those assets from Northern Star for like pennies on the dollar, I think. If you look at the September 23 news release, September 2023, it was like eye-opening to me. I mean, the stock did respond on that, but then it just faded like everything else last year, right? I think the revenue growth potential for this is going to be outstanding next year and into 2026. So that's what people need to understand, is that, yeah, they've got 6 producing royalties right now. It's going to be somewhat of a mellow next 6 months, but next year and the year after, I mean, I think they're going to get additional royalty coverage, analyst coverage. They have the NASDAQ listing, which is extremely attractive to portfolio managers, as you know. It is costly too. Let's be fair, like that is an expense that they have to carry. But I think that it was smart to do that a couple of years ago, I think about 18 months ago, because they position themselves now where we're in a great gold market and you're going to get more people, I think, that are saying, you know what, I'm not going to buy GDX. That's too much risk for my clients. Well, let me buy something like this with a 2.5% yield. It's like there are conservative investors out there that aren't looking for as much alpha. I think that you and I are.
Yeah, if they can do that revenue growth, then this stock could do extremely well. So, I mean, if you like the royalty model, Vox definitely is worth a look. Absolutely.
Fantastic. Well, why don't we wrap it here, unless you had anything else?
No, I'm good. That's it.
Okay. So next month we are probably going to do 1911 gold.
Awesome.
Looks like we're going to do that at the end of July.
That's
Uh,
going to be
so
that's going to be an exciting interview. I'll tell you. You guys want to listen to that story. I've been a fan of 1911 for quite a while now. I always knew it was a great optionality play, and I
mhm.
think that's what we're going to hear from the CEO.
Yeah, Sean will be joining us, and I believe the ticker on that is AUMBF. If you want to take a look in advance, it like so many juniors is trading down now and presents a good entry point, I think. So we'll have
Yeah,
Sean on the show,
yeah.
and
The valuation is pretty crazy. I think it's like 15 million US.
yeah, right. I mean, there's just so many values out there, but this seems to be one of them. So, I hope everyone got something out of today's presentation. And Don, thank you again for joining, as always. And hope you guys have a good summer in between now and then. Thanks for everyone for joining.